Most Europeans are told the same thing from the moment they start earning money. Renting is throwing money away. Buying is building wealth. It feels true. It sounds logical. And in most European cities at current prices, when you actually run the full numbers, it is wrong. The most expensive financial decision most Europeans make is the one everyone tells them is the smart one. This is what NTM told us, the technical layer behind the philosophy. Next 10 minutes, the real cost of buying a home in Europe that nobody includes in the calculation, the full 20-year math on renting and investing the difference, and the one number that determines which choice wins. A number most people never look up before making the biggest financial decision of their life. Why does renting feel like throwing money away? Because the rent payment disappears. You can see it leave your account. Nothing tangible arrives in return. No equity building, no asset accumulating, just a number gone. A mortgage payment feels different. Every payment is building something. The house gets more yours with every month. The number on your bank statement might be similar, but one feels like loss and one feels like investment. This is the ownership illusion. Behavioral economists call it the endowment effect. We assign higher value to things we own than things we do not. The house feels worth more because it is yours. The investment portfolio does not trigger the same feeling because the ownership is abstract. But here is what the ownership illusion hides. A mortgage payment is not building equity. It is mostly paying interest, especially in the first 10 years. A significant portion of every payment goes to the bank, not to your ownership stake. The feeling and the math are different things. They almost always are. Chapter 1. The cost. Nobody counts European transaction. Costs here is the number that changes the entire conversation, and almost no one includes it. In most European countries, buying a property does not cost just the purchase price. It costs the purchase price plus transaction costs, what Germans call Nebenkosten, that can equal 10 to 15% of the property value, paid up front on day one and never recovered. In Germany, Grunderwerbsteuer, the property transfer tax runs between 3.5 and 6.5%, depending on the state. Notary fees add 1.5 to 2%. Land registry fees another 0.5%. Estate agent fees, where the buyer pays, can be 3 to 7%. On a 400,000 euro apartment in Munich, transaction costs alone are approximately 50,000 euros to 65,000 euros. Mike Petry watched a colleague at one of the Big Four firms spend 60,000 euros in transaction costs buying an apartment in Munich. That's 60,000 euros invested in VWCE at 8% annual return over 20 years, becomes approximately 279,000 euros. The transaction cost alone, compounded, is more than most people accumulate in their entire investment portfolio. Note: this episode examines a primary residence, not a rental property where tenant income offsets the mortgage. That is a different calculation, covered in Mike's debt trap video on Nobody Told Mike, link in the description. That number never appears in the renting is throwing money away conversation. It should be the first number on the table. Chapter 2. Sofia buys. Marc rents and invests. The 20-year math. Meet Sofia and Marc. Same city, same starting point, same savings, 140,000 euros. The same amount most financial advisors say you need to buy responsibly in a European city. Sofia uses her 140,000 euros to buy a 400,000 euro apartment. Her down payment is 80,000 euros. Her transaction costs are 60,000 euros. Total upfront, 140,000 euros. She takes a mortgage of 320,000 euros at 3.5% over 30 years. Sofia's monthly costs: mortgage payment, 1,437 euros. Property taxes and insurance, 300 euros. Maintenance budget, 1% of property value per year, 333 euros. Total monthly ownership cost, approximately 2,070 euros. Marc rents the equivalent apartment for 1,400 euros per month. He invests his entire 140,000 euros in VWCE. the Vanguard FTSE All-World UCI TS ETF. He invests the monthly difference between Sofia's ownership costs and his rent, €670 per month, into the same fund. According to Vanguard Long-Term Return Research, a broad global equity ETF has averaged approximately 8% per year historically. That is the figure used throughout this comparison. All ETF names are examples only, not recommendations. Chapter 3, Year by Year, What the Numbers Actually Say. Year 10. Sofia's apartment has appreciated at 3% per year, a conservative estimate based on ECB European housing market data. It is worth approximately €537,000. But in year 10, Sofia has also dealt with reality. A boiler replacement, €4,500. A bathroom leak that damaged the floor below, €3,200, and a month of stress. 1 year where the property needed repainting, €2,100. The maintenance budget she set aside helped, but it did not cover everything. Her mortgage balance at year 10, approximately €263,000. Her equity, €274,000. After 10 years of mortgage interest, remember in the first 10 years of a 30-year mortgage, most of each payment is interest, total interest paid, approximately €97,000. After maintenance, insurance, property taxes, and those unexpected repairs, total additional costs, approximately €110,000. Net accessible wealth from the property at year 10, approximately €164,000. Marc has touched nothing. His VWCE portfolio runs automatically. He has logged in perhaps once per quarter to look at the number going up, then going down, then up more. In year 7, the market dropped 18%. He did not sell. He did not do anything. By year 10, his portfolio, €140,000 initial plus €670 monthly at 8%, is approximately €422,000. At year 10, Marc has approximately €258,000 more in accessible wealth than Sofia. Same city, same starting point, 0 emergencies. Year 20, Sofia's property has reached approximately €722,000. A significant number. It feels like success. But the ledger tells a longer story. 20 years of mortgage interest, approximately €172,000. 20 years of maintenance, insurance, and property taxes, approximately €210,000. The kitchen renovation she could not avoid at year 15, €18,000. The roof at year 18, €14,000. Total ownership cost beyond the mortgage principal over 20 years, approximately €414,000. Equity at year 20, approximately €533,000. Subtract the total ownership cost paid from salary, above the mortgage principal, and her net financial position from the property, approximately €323,000. Marc's VWCE portfolio at year 20, approximately €975,000. He contributed €140,000 up front and €670 per month over 20 years. Total of approximately €301,000. The rest, €674,000, is pure compound growth. The gap, €652,000 in Marc's favor. If the numbers are landing differently than you expected, hit like. It helps more people find exactly this kind of breakdown. Chapter 4. The one number that determines the winner. Price-to-rent ratio. The entire buy versus rent calculation comes down to one number. Not the mortgage rate, not the property price, not your income, the price-to-rent ratio. Here is how it works. Take the monthly rent for an apartment, divide it by the purchase price of that same apartment. The result is your rent-to-price ratio. If it is above 0.7 to 0.8% per month, meaning you can rent an equivalent property for more than 0.7% of its purchase price monthly, buying starts to make mathematical sense. If it is below 0.5%, renting almost always wins. In Munich, A 600,000 euro apartment rents for approximately 1,800 euros per month. That is 0.3%, far below the threshold. The math favors renting decisively. In Berlin, a 500,000 euro apartment rents for approximately 1,500 euros per month, 0.3%. Same picture. In Vienna, 0.25%. Same result. In Leipzig or Dresden, prices are lower, rents are proportionally higher. Ratios of 0.6 to 0.8%. The math becomes much closer, and in some cases favors buying. This is the number to look up before making the decision. Not is the property market going up, or is now a good time to buy. The price-to-rent ratio in your specific city for your specific property type tells you immediately which side of the equation you are on. On Nobody Told Mike, Mike Petry applies a similar three-question framework to every debt decision, covered in his Debt Trap video, linked in the description. Applied to a primary residence, does this asset service its own debt? For Sofia, the answer is no. She pays the mortgage entirely from her salary. That is the distinction between a rental property that pays for itself and a primary residence that does not. Chapter 5. The Honest Exceptions. When buying does win. The price-to-rent ratio is the primary determinant. Two secondary factors can shift the answer. First, very long holding periods. Transaction costs, amortized over 30 or 40 years, become a smaller fraction of total returns. A buyer in Germany who holds a property for 35 years recovers the transaction cost disadvantage over a long enough horizon, especially with continued appreciation. The 20-year comparison shown today becomes significantly closer at 35 years. Second, the stability value. This is not mathematical, but it is real. Owning your home provides security. No landlord can raise your rent or terminate your lease. For families with children, that stability has genuine value that does not appear in any spreadsheet. Quantifying it is personal, but denying it exists is dishonest. The conclusion is not never buy. The conclusion is this: look up the price-to-rent ratio for your city. If it is above 0.7%, run the full numbers, including transaction costs. If it is below 0.5%, in most European high-cost cities, the math strongly favors renting and investing by a margin that compounds significantly over time. And that answer only holds if you actually invest the difference. Nobel Prize-winning economist Robert Shiller spent decades studying housing returns. His research, published in his book Irrational Exuberance, found that U.S. housing returned approximately 0.1% per year in real inflation-adjusted terms between 1890 and 1990. 100 years. The asset that everyone calls the best investment returned almost nothing after inflation for a century. Mike Petry references the same Robert Shiller in his Debt Trap video on Nobody Told Mike, in the context of consumer debt and compound interest working against you. The same force that makes compound interest powerful in an ETF makes consumer debt destructive. Here it works in reverse. The illusion that a mortgage payment builds wealth when a significant portion is simply interest paid to the bank, especially in the first 10 years. European markets vary by city and decade, but the pattern Shiller identified, that the cultural belief in housing as the superior investment significantly outpaces its actual mathematical return, holds across markets. The question is not whether you should buy or rent. The question is whether you are comparing the full costs of both options honestly. Most people are not. And the part most often excluded, in Europe especially, is the transaction cost that disappears on day one. Mike Petry talks about the decisions that feel right and the decisions that are right on Nobody Told Mike. The buy versus rent decision is one of the clearest examples of the gap between the two. And if you want the full story on how Mike thinks about good debt versus bad debt, including the rental property in Germany where the tenant covers the mortgage, watch his Debt Trap video on Nobody Told Mike. The link is in the description below. The condition that determines the winner is not the city or the market or the interest rate. The condition is whether you actually invest the difference. If you rent and spend the difference, you lose. If you rent and invest the difference, every month, automatically without fail, the numbers shown today are yours. Most people rent. Few actually invest the difference. That is the real comparison. Not buy versus rent. Buy versus rent and spend. That is what Mike Petry calls modern financial philosophy. Not the decision that feels safest, the decision that the full numbers support. Here's the question for the comments. Are you renting, buying, or still deciding? And did you include the transaction costs in your calculation? Drop it below. If this breakdown clicked for you, subscribe here for more NTM explainers, and watch Mike explain the full story behind these decisions on Nobody Told Mike. Link below.